Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
Okay, today we are going to talk about home affordability.
We're going to talk about the money bit.
The money bit. And so the title of the video is The Truth About Home Affordability. And this is actually factual. So we've got this information we're going to show you. It's a chart. It comes from the government. It's actually the home affordability index, okay? And it's the index that the government, and it's all the factors that come into home affordability, right? Yes. So, Juana, what are some things? So one thing is, let's just talk about price, because right now the problem is everyone's just focused on the price. They look at prices go up and they go, oh, it's too high, it's got to go down. There's like a right number for price, right? But they never complain that their wages are too high. Like I can't believe I make 80 grand now. That's way too much. I should make less, right? Okay, so let's talk about home prices. Home prices are pretty high.
They are high. But you know, when you're looking at the whole economic spectrum of everything that we pay money for, right? So between what we pay for maybe utilities or appliances or a car, between the wages, between what it costs us when we go out to the movies or out to dinner, and you look at all of it as a whole body of expenses. So when you compare those expenses as far as portions of income and as far as percentage relative to one another, and then you put in as far as what homes cost, home affordability is actually pretty affordable. I know that it sounds crazy when, you know, home prices are $500,000 or more, and in the same market, maybe those homes were $300,000 not that long ago, but a lot of things have changed. Incomes have changed, everything has changed, and home prices change with it. Okay,
so we're going to go through some of these. So let's start with the price itself. Now, the price is a nominal amount. It's not a real amount, because the real amount is adjusted for inflation.
Right.
So if you bought a house on a beachfront community in Southern California right after World War II, it was probably $2,000 for a little house, but on a beach or right in one of those like little areas you go, like Newport Beach, right? Those little cute houses that are a few million. It was $2,000, but remember, $2,000 was like you didn't make $2,000 a year. Like it took years of your earnings to be able to buy a house, right? So even though the number is the highest it's ever been for homes, adjust for inflation, it's not that bad. We used the analogy before of the 5-cent movie ticket in like 1939. I think it was 5 cents was a movie
versus
ticket.
Almost $20 now.
Yeah, it's more, but and so movies are actually less affordable because the CPI has movie prices have gone up faster than the CPI, right? College tuition has gone up faster than the CPI. It's exploding. It's like much less affordable.
CPI, Consumer Price Index.
Consumer Price Index. Now, but other things like certain durable goods, certainly computers, technology, they're underperforming the CPI.
Right.
It actually, the same price today, you buy a really nice computer for, you would have paid that same price in 1985.
Right, and in 1985 that was a fortune.
It was a fortune, and it was a much lower, you got a much less, you just got something that really didn't do that much compared to what computers do today. Okay, so we're gonna show the chart, don't leave yet. Let's talk about interest rates.
Yes.
Now interest rates, let's talk about the 1990s, 80s, and 70s compared to today, because everyone's freaking out that rates are going from like 3 to 4%, and that's gonna crash the market, right? So what were rates like in maybe the 80s?
They were, you were paying 18% for your mortgage and you were happy for it because there were people paying 20, 21%.
Okay. So even around 2000, they were still 8%. They're still half of what they were. Okay. And then let's talk about wages. Wages have gone up. Wages are going up right now. Some of that's inflationary. The savings rate has gone up. People have more money. People have more wealth.
Right now, Americans have more money in savings as a body than we've ever had.
Okay.
Because we're not savers. We're not the Germans. Germans are savers. We're not savers. We like to spend it faster than we make it.
Okay. So before I'll show you the chart. We'll go to the chart and then we'll talk about it. Okay. But before I show you, I just want you to think about one thing. I want you to think about what home affordability looked like, say, 20 years ago, and then you think in your mind, are homes more affordable today or more affordable 20 years ago? Okay? And just think about that, like what that would look like. And here's the chart. So we're putting the chart up. So this home affordability index chart. Now, if it's high on the chart, homes are affordable. That means they're more affordable. If they're low on the chart, they're less affordable. So the index is how affordable is a home. If it's a high number, it's more affordable. Low number, less affordable. Okay? So if you go back to that dip right at the bottom where it touches that 100 line, that's the last time it hit 100. That was 2006 at the top of when the bubble bursted last time. Okay? Home affordability was 100. You can see it went up from 2009 or 2006 to about 2012 to up 200. That was historically 2012 to 13. Homes were the most affordable they have ever been. Right? Because the market crashed, homes got cheap, and they became more affordable for people. Now, what's funny is I asked them to do the 20-year thing, right? So if you look at this chart and you go back 20 years and you go back to the early 2000s, we're still more affordable than we were 20 years ago. And if you go back 30 or 40 years, we're way more affordable. And if you think about that, if homes are more affordable, why would home prices crash?
Right. The other thing to keep in mind is that homes have changed. So, homes have gotten bigger, so we're getting more bang for the buck. That's the other thing, versus affordability. So when homes were less affordable, homes were also smaller. Homes have now, depending on where you're looking on the chart, are more affordable, and they're also at record sizes. This is the biggest our homes have ever been.
Yeah. The value of a home, because the other thing too is you can't look at the price because, so here's a good analogy. In 1997, the median home built in Las Vegas was 1,600 square feet. That was in 1997. It was about a decade later, 2005 or 6, the median home that was being built was 2,000 square feet. So you can't just look at median prices because homes are bigger, so the prices are bigger. So it's not the same home. It's not just the same home that's selling for more money. They build new homes, they build bigger ones. Here's another phenomenon. Let's talk about beach communities. You have a lot in Coronado, San Diego, beautiful area. It was built in the 40s or 50s. It's on a 6,000 square foot lot, let's say, and it is a 1,500 square foot house, right? So what do you think's going to happen to that house?
That house, that is, in real estate, we like to say that land should be used for the highest and best use of the land. And in this case, having a small home on this lot is not the highest and best use of the land.
Okay.
So what happens is people will purchase these homes. They will go ahead and expunge the land of these homes, and they will put on either a bigger home, or they will put on two skinny homes that are each larger than the original home was.
So they're going to upgauge the homes.
Yes.
People also do additions. That happens too.
Yes.
So home affordability, because it's this index that you're looking at, doesn't just take into account the price. It takes into account inflation, the CPI, wages, the ability of people to borrow, the lending environment, the savings rate. If you make the same amount of money, but everything you pay for is relatively less, in real dollars, homes are more affordable. And that's another thing people don't realize. Food is more affordable. Look, the price of eggs and bread isn't much different than it was 20 years ago. The only difference is that amount you paid was more money back then. So everything that you pay for the most part, is less expensive, except for college and a few other things. Fuel today.
Right.
We're not talking about fuel. That's a short-term thing. Okay. Homes are affordable. Now, if you look at this chart, you'll see the last year, they were, remember when people said the market was going to tank a year ago, 2021, it was almost at 200 home affordability in it. It was like literally the most affordable they'd ever been, but people didn't like the prices and they saw the pandemic. And now they're talking about the war in Ukraine, and they think that's going to cause it to fall. we still have a long way to go before, home prices would have to continue to rise probably 50% more, and then no other thing change for them to be unaffordable enough to where we'd have a big price correction probably.
Right. And look, inventory levels don't support home prices even flattening, let alone going down, because we have record low inventory levels. Supply and demand, very basic. So we have more buyers chasing fewer homes, so home prices will continue to go up until there's a change in the market as far as bringing more properties to market, or for whatever reason, less buyers being interested in purchasing homes.
Okay, so what is it going to take? The Home Affordability Index has averaged probably 160, 170 for the last decade. It's at 143 right now. So it's not as affordable as it was maybe a couple years ago, but it's certainly more affordable. Historically, we're certainly in a better position, okay? We've said this on every video. This is not sustainable.
No.
Unless we get 20% inflation every year, which is not going to happen.
We hope.
No, I think inflation is going to fix itself. And if that happens, great. We're going to get a nice soft landing. Real estate prices probably just kind of chill out for a while. Maybe even slight decline, but slight decline is not a crash, because we're not going to go below where we were 2 years ago. That's not going to happen.
So here's the thing about a slight decline. Because we're not having that many transactions, because we just talked about not having a whole lot of inventory. So even if there's a decline, not that many people are going to be impacted because there aren't that many people entering the market. So,
right.
So that's another thing that I don't know that a lot of people are considering. Most people have a lot of equity. Those people entering the market, meaning that they've just purchased a home, they're a small percentage when you look at the whole body of everybody else who owns a home. So even if you're the person left standing when the music stops playing, you're the only one. I mean, there are very few people versus everybody else who will still have equity.
If you bought Apple stock in 1980, today you're super rich. I think the numbers I heard were, if you bought $1,000 of Apple stock at IPO, which was back then, it was such a high, it was $1 billion company when it IPO'd, which was unheard of. And people were saying it's overpriced, it's not worth that it's worth over $10 million today, or 20 million or something. It's worth a ton, 20 something million, okay? It's a lot of money. Now, what they won't say is, but remember in 1991 when our value of Apple fell $50,000 that year? Because they don't care, because they didn't sell it. They didn't buy at the beginning of the year, sell at the end of the year. It just values changing. When you look at the real estate values historically, and you can just go back 40 years, except for 2006 to 2012 when they tanked, it's pretty much a straight line. You can actually draw a line from home prices going up pretty nicely, beating inflation. Home prices have always beat inflation by 2 or 3%. And I think that's the thing that is driving the market. I do think that the home price affordability was so high 2 years ago when the pandemic hit. People fled into real estate that were renters. And I think investors and hedge funds recognized home affordability. This chart is being looked at not just by us, because the average person doesn't know this. And here's something, Juana. Somebody commented on one of the reasons we're doing this video is somebody commented today that, quote unquote, everybody knows homes are the least affordable they've ever been, unquote. That's literally what he said. He said that as a quote on the video. Everybody knows that blah, blah, blah. And it's no, it's there. And I'm actually, that's not the true. That's not even close, because we're still 30% more affordable than we were in 2006, according to the index. But the thing is people don't look at this. People don't understand, I don't think. But people in the financial world, they look at these charts. And I bet you there's some hedge fund guy going, hey, wait a minute. Home affordability is the most it's ever been historically, almost ever. And there's a pandemic going on. There's potentially some inventory hit in the market. Let's go buy a bunch of houses and hang on to them forever, since they're so affordable. And then in the future, when they're worth a ton of money and relatively more affordable, we'll beat inflation. We'll make a huge amount of money, right?
Right. So look, there are very smart people looking at this, and they're making decisions to still stay in real estate, to continue to purchase real estate. These are people far smarter than we are, and they are making these choices. So we're not the only ones that are saying this is still a very viable way to go. At the end of the day, everybody needs a roof over their head. Everybody needs a place to call home. So homes are always going to be popular as far as a place for people to invest, to put their money, and particularly in an inflationary environment like we have now, homes have traditionally outpaced inflation as far as their rise in value, even when the stock market hasn't.
I think as long as it's cheaper to buy than rent, which it is right now in most markets, the home prices are going to keep going up. Home price affordability in every state is higher than it was in 2006. It's across the board. Rents are higher. Rents are going up across the board. There's not any market where rents are declining, well, except for maybe San Francisco, but that's an outlier, right? We did that video already, the rent video. I think we're going to keep saying this. We're not pumping real estate. We put our money where our mouth is. We recently did acquire an investment property, very recently, even at the highest home price that the thing has ever been worth.
Yes.
Because we felt, hey, this is a good investment. If you believe that the market's going to crash and homes are overpriced, give us a call. We will gladly sell your house for you. We will help you get top dollar, probably over list price. We will list it for more than the last house sold for, and probably get more than that. Probably, potentially. Okay, no guarantees or anything on that, but it's like, I think, how many is it? 4 or 5 in a row now that's happened. 4 or 5 in a row. Okay. What else?
Look, real estate's still a good investment. If that's not your bag, we totally get it. We'll sell your house. If you like the video, please hit the like button, the thumbs up. Share the video with your friends. Please leave us comments. We love the comments. We love responding to them.
We respond to every single comment,
Yeah.
unless it's absolute trolling, and then sometimes I respond and I troll back. So we respond to all the comments,
Right.
and it's actually us responding.
Right. So, look, if you like our videos, please engage with us, because this is we would like for this to be a two-way conversation, not just us talking at you, but talking with you.
Yeah. And if you have any video you want to see, like, hey, what about this? What about this? If it's feasible, we'll do it.
Yeah.
Yeah. All right. Thanks for tuning in. Thanks for watching all our videos, and we'll see you on the next video. Bye.